Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that's up. Now, if you're not on my free email list, you need to get on it to get all my free stock trading updates. Typically send out an email before every day in the opening bell. In the description, there's a link for you to subscribe. Now, it's a big day in the markets. We got the CPI report this morning. It showed that inflation in December actually declined a little bit from the previous month. And this thing is, we're now set up for the next couple months that we're probably going to get some good inflation numbers. And the reason why is that last year, from January, February, March, April, those were the biggest months where inflation really grew because that war in Ukraine began in February. And so when you look, when we're going to get the annual comparison, they're going to show good numbers relative to what there was last year. And that sets the stage for the Federal Reserve to only do one or two more interest rate hikes. We're at the end of the rate hiking cycle, the start of that rate hiking cycle, and then the acceleration of the 75 size rate hikes last year. That's what slammed the stock market down. And now that we're at the end of that cycle, we're seeing the market go up. But you have to understand the real reason you're seeing the market go up so far this year, and it's been really going up since the end of October, is that there's more money coming into stocks than out. I mean, that's obvious. But what you need to know is that that money is not, at one way, it may be hard to discern this because when you look at stocks like Tesla, Meta, Google, when you look at funds that invest in so many of the so-called technology and innovation stocks, such as ARK, they're barely off their highs. They're not doing that great. And if that's all you pay attention to, you wouldn't really realize that the market is much healthier than those stocks are because the buying happening is broad-based. It's not focused to those stocks, and those stocks are still acting as laggards. Someone that's only invested in, say, Tesla is missing out on what is now a broad-based rally. That rally also is seeing even stronger buying in foreign markets and in mining stocks, which have been leading the market since October, meaning outperforming better than the S&P 500. This is the year in which it pays to not be invested in Tesla, but to be invested in silver and gold and mining stocks. And when you look beyond them, in so many stocks in the market, I'm going to show you exactly what I'm talking about now, because I want you to do well this year in the markets, not be stuck in millstone situations like Tesla or the ARK ETF. So this is what I made note of in the update this morning, and that is that the percentage of stocks in the New York Stock Exchange above their 200-day moving average broke through their November highs yesterday. This is the internals of the market. When this is going up as it's been going up, it means that more stocks are going up than going down, and these stocks are doing better than the Nasdaq, even doing better than the S&P 500. So maybe the way to really make money now going forward is to look at the charts in stocks all across the market, not inside the Nasdaq, and look for the ones that have the most constructive chart patterns. And you may notice if you deep dive into this, like I did this weekend, these tend to be stocks of stable earnings and even stocks paying dividends. That's what's hot in the market now. This is not 2020. This is not 2021. And we're not going back to that because we're in a completely different market environment. There are people out there worried about an economic slowdown. And if you're an institutional investor or any investor worried about an economic slowdown coming, then what you're going to want to invest in are companies that have stable earnings. You're not going to want to invest in debt monsters that high interest rates make their costs accelerate, weaken the balance sheet, put them at risk, and then have trouble in their consumer markets. Tesla is even having to slash the prices of the cars it's selling in China. That's a bad situation. You want to do situations that are in companies with the opposite: healthy balance sheets, stable earnings, good dividends. That's what's coming alive in the stock market. And this indicator warned of a correction or a bear market in 2021, and it came, and now it's forming a positive divergence, indicating that if you're in the right stocks, in the right sectors, not the past fad stocks that are now still lagging, and then you can do well. You can win in this market. And I've been trying to point out some of these situations the past couple of days. And this morning, I said, look at REITs. REITs are about to break out, and the relative strength indicator on the bottom of this chart, comparing REITs to the S&P 500, is about to break out too. It's been firming up since November, setting it a situation where this ETF, and more importantly, the stocks inside of it, could break out and really take off. Now, to give you an example, and we'll look at some of those stocks, but to give you an example of overall what I'm talking about here, look at this chart. This is the New York Stock Exchange primary index made up of thousands of stocks. It's above the November high. The relative strength ratio, comparing it up to the S&P 500, is trending up. It's at a new high for the past 52 weeks. This is again showing us that a broad-based average, thousands of stocks, is doing better than the narrow-based Nasdaq. If you want to beat the market this year, which is if you're serious about making money, that's what you want to do. You want to think about beating the performance of the S&P 500. If you can't beat the performance of the S&P 500, you just cut off the video, buy SPY, and forget about it. But if you want to beat the market, that's if either buy SPY or try to beat the market. Those are your two choices. The other choice is just gamble. Well, you're just as likely to go bust if you do that. And look at all the crypto gamblers when what's happened to them. If that's what you want, to go somewhere else. I'm here to try to find more steady situations that have a higher probability of beating the market, giving you good return, maybe even paying you some dividends in the meantime. And NASDAQ is not where that's at. The 100 stocks of the NASDAQ as a whole are lagging the S&P 500. Still, this year, avoid them. They're not going to tell you that on CNBC, and Kathy Wood is going to tell you the opposite. Well, look at ARK. ARK is a millstone investment, still lagging the S&P 500. It's awful. It's barely off the high, whereas it's below the green line, which is the 200-day moving average, whereas the New York Stock Exchange, thousands of other stocks, is now above the 200-day moving average. And my goodness, look at the price of gold, surging today, well above the 200-day moving average. Gold outperformed the stock market last year. It's outperforming the stock market now. And so is the price of silver. SLV is a silver ETF. And mining stocks such as Newmont, which I own, are doing well, outperforming the market, going up steady, paying about a 4.5% dividend. One of the best performings in the stock market, period, is this stock, Southern Copper. These are the type of stocks coming alive, that basically the opposite chart of Tesla. Focus on stocks like this. Yes, I own Newmont and I own Southern Copper. I've been owning them now for quite some time. But let's talk about some REITs that I bought recently to show you what I'm talking about. Here is MAC. It's turning up, positive relative strength. Here's one that's doing really great today, and it's breaking out of the December high, breaking out of the November high, up 3.78% today, paying a very healthy dividend. I'd rather own this than Google. I'd rather own this than the ARK ETF. I'd rather own this than Tesla. This is a stock that can easily go to 155 and it's going to pay a nice dividend. It's beating the market. Look at the indicator on the bottom of this chart. Since October, the relative strength line has been trending up. If you want a good stock, you look for stocks where that's been the case. You avoid stocks that indicator is going down. Simple as that. Go by that rule this year and see it. I believe you'll get much better results than you've got over the past couple years. Look, I'm going to tell you reality. In the 1990s, an economics professor named Terrence Odian did a study of hundreds of thousands of brokerage accounts to see how they performed. What he discovered was that and this was in a bull market, 50% of the people lost money even when the stock market was going up. A quarter of the people simply matched performance of the market. And these are active traders. And only 10% of the people beat the market in a meaningful way. And they did not do it by doing what everyone else is doing. They did not do it by opening up their app and then buying a Tesla because everyone else owns it. They bought stocks that people were not paying attention to until they went up, and then they bought. You want to get in early. I believe this is an early situation. It's breaking out. Do you know anyone telling you to buy REITs? Do you know anyone telling you to buy mining stocks? Or are they still telling you to buy Tesla, buy Tesla, buy Tesla, buy Bitcoin, buy this crypto crap? No, buy things grounded in the real world. REITs are real estate investment trusts that own properties that exist in the physical real world, not metaverse, and they rent them out and get money, and they give you a percentage of that money as a dividend, stable earnings, and they're going up. The sector has come alive. Okay, here's the one you may be familiar with that I bought, Lamar Advertising. If you drive down the road and you see billboards that say Lamar on them, that's this company. This is the stock. It is a REIT too, and it pays a healthy dividend. I own it. And they got signs all across the United States. That's real world. They're not advertising in the metaverse where no one goes, but where everyone goes on the highways every single day. And that's stable earnings. Do you think the highways are going to go away? Do you think metaverse is going to catch on? It hasn't yet, but even if it did, the highways are always going to be there. Here's another REIT, Essential Properties Trust, breaking out of the December-November high. Is ARK breaking out of the November-December high? No. It's still below it. A laggard. Avoid the laggards. Get in the winners. And look, you saw the end of a bull market in 2021, and then a bear market in 2022. And what happens at the end of a bull market, the very end, is most stocks end up falling, and the averages continue to go up. That's why this indicator was going down in 2021, while the S&P continued higher, the Nasdaq continued higher. And the reason the averages keep going up while most stocks are going down is because a few stocks heavily weighted in the averages lift them up, create the illusion that everything's fine until it's not, and then you have the bear market. And those stocks that were the former leaders of the last bull market do not lead new bull markets. In fact, they can lag for 10 years or more, or even in some cases go bankrupt and cease to exist. That's what happened with the technology stocks of 2000. That's why the ARK ETF that did so well in 2020 is now a complete bust. And look, RWR ETF will beat ARK this year. Bank on it. I'm putting my money in that because that's what I'm buying REITs. I'm not buying the stocks in ARK. I'm not buying Tesla. I'm not buying crypto coins. I'm buying things with stable earnings, things that are performing better than the S&P 500, because I want to beat the market, and I want to encourage you to think that way too. So if you like this video, hit the like button. If you want to get my next video and you're new to me, hit the subscribe button, hit the bell next to it, and then YouTube will send you an alert as soon as the next video is up, and I'll be talking with you later.